inside the quiet power shift of global capital. It didn't happen with a crisis. There were no emergency meetings, no dramatic headlines, no sudden collapse to mark the moment. Yet beneath the surface, global capital was already moving slowly, deliberately, and in a direction few were watching. This story matters now because power in financial markets rarely shifts through confrontation. It shifts through flow, through where money chooses to go, where it chooses to stay, and where it quietly stops showing up. To understand why today's markets feel different, more fragmented, more selective, we need to trace the moment capital began changing its allegiance. It started after years of expansion. Capital had grown comfortable moving freely across borders, chasing yield wherever it appeared. Liquidity was abundant. Barriers felt low. Risk was priced globally, almost uniformly, as if geography no longer mattered. Money moved fast because it trusted the system it moved through. But that trust began to thin. The early signal wasn't political. It was behavioral. Large pools of capital stopped behaving the same way. Sovereign funds shortened horizons. Institutions began favoring control over reach. Long-term investors quietly reduced exposure to regions once considered core, reallocating not because returns vanished, but because certainty did. At first, the shifts were invisible. Flows adjusted at the margins. Allocations tilted slightly. No one pulled out completely, but the pattern was clear to those who tracked it closely. Capital was becoming choosier, more defensive, less willing to rely on assumptions that had held for decades. The reveal deepened as fragmentation increased. Trade slowed. Regulation diverged. Currencies behaved less predictably. What had once been a single, integrated system began showing seams. Capital responded the only way it ever does to uncertainty. It sought insulation. Money moved closer to home, into familiar legal systems, into assets backed not just by yield, but by perceived control. This wasn't fear-driven retreat. It was strategic repositioning. And as these decisions compounded, something fundamental began to change. Global capital wasn't disappearing. It was reorganizing, quietly. And once that process begins, it rarely announces itself until the balance of power has already shifted. As capital repositioned, its behavior revealed a deeper transformation. Investors weren't chasing maximum return anymore. They were pricing in jurisdiction, stability, and control as core variables. Yield mattered, but only after trust was secured. The reveal sharpened when long-standing assumptions began to fail. Assets that once moved together started diverging. Capital flowed into markets with lower growth but higher predictability. Meanwhile, faster-growing regions struggled to attract the same scale of funding they once took for granted. The map of opportunity was being redrawn. The early conflict emerged inside institutions managing global exposure. Diversification models, built for a world of convergence, began breaking down. Geographic spread no longer guaranteed risk reduction. Political decisions, regulatory shifts, and capital controls became market-moving forces overnight. What had been background noise moved to the foreground. Sovereign funds led the adjustment. They prioritized strategic alignment over pure performance. Infrastructure, energy security, and domestic resilience gained favor. Capital was no longer just financial. It was geopolitical. Every allocation carried implications beyond return. Private capital followed more cautiously. Funds restructured vehicles. Time horizons shortened in uncertain regions. Exit strategies were reconsidered before entry. The question changed from where is growth to where is durability? Meanwhile, countries felt the shift unevenly. Those offering stability saw inflows persist. Those dependent on constant external funding felt pressure build quietly. Currency volatility increased. Financing costs rose. The power to attract capital became less about opportunity and more about confidence. What made the shift dangerous was its subtlety. No single withdrawal signaled alarm. No collapse forced attention. But collectively, the movement altered liquidity, pricing, and influence across the global system. Capital wasn't reacting to crisis. It was preparing for one. And in doing so, it was changing the balance of power, without anyone declaring a winner or a loser. The quiet power shift was already underway. Most were still looking for a headline. The tensions surfaced when the consequences became unavoidable. Markets that once relied on steady foreign inflows began showing stress without any obvious trigger. Liquidity thinned. Volatility increased. Prices reacted sharply to news that would have barely mattered before. The system felt less forgiving, more reactive. The conflict intensified as policymakers realized what was happening. Capital wasn't fleeing, it was choosing. And those choices reflected long-term confidence, not short-term sentiment. Attempts to lure money back with incentives produced only temporary relief. What capital wanted now was assurance, not promotion. Institutions adjusted again. Exposure limits tightened by region. Risk committees rewrote assumptions that had guided decades of global allocation. Models that once treated capital as neutral were forced to account for politics, regulation, and control. Finance and geopolitics merged into a single equation. The shift became visible in currency behavior. Some currencies strengthened despite weaker growth. Others weakened even as economies expanded. The old logic broke down. Investors were voting not on performance, but on reliability, on rules, on the expectation that capital would be welcome tomorrow the same way it was welcome today. As pressure built, feedback loops formed. Reduced inflows increased volatility. Volatility discouraged new investment. Local institutions absorbed more risk as foreign capital stepped back. Balance sheets stretched. Vulnerabilities accumulated, not through collapse, but through quiet absence. This was the most dangerous phase. No panic, no crash, just a gradual reweighting of influence. Capital was consolidating power where it felt safest, leaving other regions more exposed to shocks they could no longer buffer. The global system hadn't fractured, but it had hardened. And once capital hardens around perceived centers of trust, reversing the flow becomes far harder than stopping it. The quiet power shift was no longer theoretical. It was shaping markets in real time, and the final implications were about to become clear. The climax emerged as the global system adjusted to its new reality. Capital had finished reorganizing, not evenly, not fairly, but decisively. Influence concentrated where trust, control, and predictability aligned. Other regions learned painfully what absence felt like. The resolution unfolded through adaptation. Countries strengthened domestic markets. Local capital stepped in where global flows retreated. Policies shifted from attraction to retention. Stability became a competitive asset, not a given. The era of frictionless global capital quietly ended. For investors, the lesson was sobering. The world had not deglobalized, but it had repriced globalization. Flows became selective. Correlations weakened. Old diversification strategies lost power. Understanding where money felt safe became as important as understanding where it could grow. Modern relevance is everywhere. Markets today feel more fragmented, more sensitive to politics, more reactive to trust. That isn't noise. It's a legacy of shift that happened quietly, without ceremony, and without warning to those who weren't watching flows instead of headlines. The story wasn't about retreat. It was about realignment. Because capital doesn't argue. It moves. And once it moves quietly enough, the world wakes up to a new balance of power already in place. Sometimes the smallest shift in perspective becomes the beginning of a new future. In